What is up, everybody? Sean here, and today I want to talk about what I truly believe is one of the greatest long-term, least time-consuming, and probably one of the safest type of investments that you can actually make. And this is really an investment that overall probably gives you one of the greatest returns compared to almost any other thing that you do, and that is index fund investing. Now, for those of you who know me, you know that I'm a real estate guy. I love investing in real estate, and a lot of my money is in real estate. However, real estate can be very, very time consuming, and it's something that not everybody wants to get into. So that's why I feel that this particular thing, index fund investing, really probably is overall probably the greatest long-term, one of the safest, and by far the least time-consuming thing you can invest in. So in this video, I'm going to share what an index fund is, why I truly believe it's so much more lucrative than even individual stock picking. We're going to be talking about how to go finding index funds and what are some good ones that you could maybe look into. And then at the very, very end of this, I'm going to be sharing a really awesome portfolio technique or strategy that over the last 10 plus years has yielded a 99% of the time it has yielded a greater return than individual stock picking. So it almost over the last 10 to maybe 15 years or so pretty much has basically always beaten out individual stock picking. So we're going to dive into that at the very, very end of this video. But if you can do me a solid right now, go ahead and smash that like button, hit the subscribe button for me as well. That really just helps with the YouTube algorithm. If you feel this is great knowledge or great advice, or if you're really into financial independence, financial freedom, creating life on your terms, entrepreneurship, make sure you smash that like button. Check out some of my other videos after this particular video, and let's just dive right into it. So the very first thing I want to talk about is the 3 common lies that we typically hear, or we tend to hear a lot of, that keep people from investing and keep people from actually building wealth. Now, the very, very first one that I hear a lot of and I see a lot of online is that investing is only for the rich. And it makes sense, right? Because when we start thinking about all these like really big investments and people investing, hundreds of thousands of dollars, millions of dollars, and these share prices are so expensive, it becomes very easy to feel like, hey, unless I'm making a ton of money, I really can't invest. But that simply isn't the case. Did you know that if you invested only $200 a month and you got an 8% return, within the next 45 years, you would have at least $1 million or more? That's only $200 a month. For most people, that's just a few simple changes of maybe eating out a couple less times during the month, or maybe getting rid of that daily Starbucks, or whatever it might be. But $200 is not very, very much. And it's something that almost any single person can do. So you do not have to be rich to actually get invested. And in fact, if you do not have a lot of money that you're making, I would say it's even more imperative that we do start to invest so our money starts to work for us. Now, the second lie that we're usually told is that investing is too time consuming. Because let's face it, every time we hear about stock market investing or even real estate investing, there's all this in-depth analysis. You have to analyze all these reports, read financial statements, survey the market. Is this a better investment than this? It takes a lot of time. Now, yes, in traditional aspects, true stock investing can be super time consuming if you do it the right way. If you are truly looking into the financials of the particular company, you're looking at the industry, you're looking at market trends, you're looking at leadership, that takes a lot of time. But the great thing about index fund investing is that this literally could take maybe upwards of a couple hours a year out of your time. So this is actually a super, super, not time intensive, investment strategy. So this is why I love index fund investing so much. Now, the third one is that investing is too risky. We hear this all the time, right? We all have that cousin or that relative or that friend who tells us like, hey, I know a guy, or I invested in the stock market and I lost everything. Or, I've heard people all the time like, oh man, I invested in real estate, or I knew someone invested in real estate and they lost everything. Investing is really, really risky. What if you lose all of your hard-earned money? Well, let me put it this way. Did you know that there's been no one who has ever lost money investing in the S&P 500 index fund as long as they held that investment for at least 20 years. No one has ever been able to lose money doing that. And in fact, with index fund investing, the longer that you hold and the longer term that you maintain this investment, the less risky it gets. So how's that for risk? So let's start with the basics. What is an index fund? Because we hear a lot of different terms. We have stocks, we have mutual funds, we have index funds. So what is a index fund? An index fund is simply a group of investments that you own a particular percentage of. Now, that might sound kind of weird. So what do I mean by that? Well, an index fund typically has a group of individual stocks or individual companies in it. So, and it could be anywhere from like 10 to 30 to 50, upwards of 100 to even thousands of companies, depending on the type of fund. So essentially, it's a group of individual stocks. And when you invest into that group, essentially your money is being spread out and put in a little bit into each individual stock or each individual company. As opposed to investing in an individual stock where if I put $100 into Apple, all that money is going just to Apple. Versus if I invest in a particular fund that maybe has Apple and has Tesla and has Google and has Verizon and has all these different things, well, that $100 is being spread out with a little piece going to each individual company instead. Now, index funds comes in all shapes and sizes, and they come in all different types of industries or sectors. There are some funds that are comprised of a small group of maybe, 10, 20, 30, 50 companies, and there are funds that literally comprise of thousands of companies. One of the most popular funds out there, which is the S&P 500, tracks the 500 largest companies on the Standard & Poor. Now, like I said, there are index funds for basically any type of investing that you want to do. If you want to invest in real estate, there's all kinds of index funds out there that allow you to invest in the overall real estate market. There are bond index funds. So if you want to invest in a group of bonds, if you want to invest internationally and you want to be in a certain area, let's say, in Europe or in China or something, there are index funds that track those markets. There are index funds that track tech. There are index funds that track blue chip. There are all kinds of different index funds. So if there's any type of industry or sector you want to invest in, there is more than likely an index fund that is appropriated for that. So what makes index funds so lucrative, and why are they what I feel an even better investment than individual stock picking? Well, the very first thing is that they have very, very low costs associated to them. You see, one of the biggest things that hamper or that weaken our ability to maximize profit are fees. So let's take mutual funds, for instance, which is a very common fund strategy to invest in. Mutual funds are actively traded, meaning that when there's an actively traded fund, there is a person, a professional stock picker who has been hired to buy and sell for you. And this is the case in mutual funds. And while we think that can be really great, thinking like, wow, like I could have someone else actually, pick stocks for me and they can buy and sell, for me instead of me trying to figure it out, that will give me a much better chance. The problem is that there's a lot of fees associated to having professionals pick stocks. The average mutual fund usually costs between 1% to up to 2.5% of within fees. These are known as expense ratios. And here's what's really interesting. An index fund usually only charges 0.03 to 0.04, meaning that mutual funds can be anywhere from 12.5 times to up to like 65 times more expensive than an actual index fund. So the question becomes, well, yeah, but here's the thing. But if there's an individual person investing for me, like, won't I get a higher profit? Here's some interesting facts. Now, it is said that for every 1% of fees that you pay out, you essentially can lose up to 20% of lost profits over the course of your investing career. So while 1% seems like a very, very small amount, it really can make a very substantial difference over the course of 10, 20, 30 plus years of investing. So it's really, really important to have ultra low expenses. Now, the next reason why I love index funds is because they perform so much better than actively managed funds or usually individual stock picking. Now, I know you might be thinking like, well, wait a second, but if I had a professional picking stocks for me, wouldn't I have a better chance when I invest in a mutual fund to do better than the overall market if this guy's actively buying and trading? Well, statistically, this is actually not the case. According to statistics, index funds beat out actively managed funds 92% of the time over a course of about a 15-year period or so. Now, keep in mind, if you're an individual investor who's investing themselves within the individual stocks or even in funds in general, you will do even worse. And that is because most people invest emotionally. You see, when you have a professional stock picker, they went to school, they studied, they spent their entire life coming from some of the probably top institutions financially, and that they're managing these massive funds. So imagine, if 92% of the time index funds beat out actively managed funds, how are you expected to do even better than that? Now, I know there's going to be these people that are going to be leaving in the comments like, hey, yeah, well, you know what? I invested in Tesla this last year and I 8 times my money. Yes, sure. There are some people who will invest in a single stock and will make an insane amount of money in a particular month or year or day or whatever. But you have to understand that these are anomalies. And while they do happen, those same people are very, very just as likely to, on the next round, lose 80 or 90% or 100% of their money. So statistically, over the course of a 15-year period, index funds almost always beat out actively managed funds, upwards of 92% of the time. And if you don't believe me, listen to Warren Buffett, who is a massive proponent of index funds, especially for the average investor. And in fact, he just recently finished a contest, a 10-year contest that he did, where he went to a group of hedge funds. He said, look, I'm going to invest X number of dollars into an index fund. I'm not going to touch it. I'm not going to sell it. I'm just going to just reinvest those dividends, just let it just keep building over the next 10 years. I will let you invest the same amount of money, and you can buy and sell however you want, whatever strategies. You can buy and sell all the top hedge funds, mutual funds, whatever you want to do. And over the next 10 years, I will beat you. Well, not only did Warren Buffett actually beat them, but his returns were 85% compared to only 22% over the course of the 10-year period. The reason why index funds are so much better is because most of the time, especially with individual investors or even professional stock pickers, number one, we just do not know the market. No matter how much you study, no matter how much you analyze, no one truly knows what the market's going to do. And then number two is, when we deal with humans, there is always some bit of emotional investing involved. And index funds are what's known as passively managed funds. So there is no person who's buying and selling. It literally is an algorithm that indexes or tracks the actual index or the market or the sector of funds that you are investing in. So it basically just matches exactly what the collective of those things are doing. Now, the third reason why I love index funds so much is because of diversification. Now, if you've watched a lot of my videos before, you know I'm a huge proponent of diversification, and that's because it really lowers the downside potential. What do I mean by that? Let's say you decide to individually invest in Apple, and let's say that they have a failed product launch, or they have a product that comes out that doesn't go as well as they hoped. Or let's say news gets out about some information about Apple that we didn't know, and it scares investors and they start selling. Well, now all of a sudden the stock starts to go down. Well, if all of your money is just in Apple and the stock starts to take a plunge, well, your money takes a plunge with it. Versus when you are diversified and you have some of your money in Apple, you have some of your money, let's say, in Tesla or Google or Verizon or whatever company that you have it in, and you have it in a group, while one company might be going down, another one may be going up. And so it kind of averages it out. So you have a lot less risk involved of actually losing your money. Now, the fourth reason why I love index funds so much is just how little time is involved. You see, if you're really going to be an active stock trader, if you're really going to be buying and selling, it takes a lot of time. You got to analyze, you got to see the trends, you got to see the shifts that are happening in the economy, the products that are being launched, the people that are involved in the companies, and it takes up a lot of your time. Index fund investing requires virtually no time at all. It takes initial time to buy the fund, and maybe a couple times throughout the year, you just kind of quickly analyze it, see how your fund is doing, but you don't need to buy and sell. And in fact, the whole point of index fund investing is for long-term growth and long-term hold. Usually when you invest in an index fund, you're investing in it for the next 10, 20, 30 plus years. The thing I love about the less time is that instead of spending all your time trying to analyze stocks that you probably are not going to be able to figure out anyways, you can spend that extra time working a side hustle that will allow you to earn extra money, and that extra money you can keep putting into the index fund itself as well. So instead of spending all your time trying to time the markets and trying to find the best time to buy, best time to sell, spend that extra time actually developing a new skill or working on your business or finding a side hustle where you can earn a couple $100 extra a week, and then take that extra money and continue to invest in the index fund. When you do that, you're going to come out way, way ahead as a long term over the next 10, 20, 30 plus years than you would be trying to buy and sell and time the market. Remember, no person, no matter how smart they are, can truly time the market. And we hear this all the time. We have all these financial experts, going on the news. Everything's going to crash or everything's going to go up. And then it doesn't happen. And then all of a sudden they're like, well, I didn't say that. I was just saying that, blah, 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 blah. Like, no one truly knows. Yes, based on indicators, based on certain trends, we might kind of have an idea of how it may start to trend or happen, but no one truly knows. And so when you're trying to buy low and sell high, you run so much risk of error. When you invest in index funds and you're just investing, every couple weeks or every month or every quarter, and you're just keeping it long term, you know that in the history of stocks always go up long term. There will be periods where it goes down, there will be periods where it goes up, but long term, it always trends upwards. So let's talk about what's called the 3-fund portfolio. This is a really awesome index fund strategy that not only helps you maximize your returns, but in fact, over the last 15 years, 99% of the time, it has beat individual stock traders. Now, the whole idea of this 3-fund portfolio is to literally create the broadest exposure possible while mitigating or minimizing any of the downside risk. Now, of course, there's always some little bit of downside risk, and there's always going to be some moments where the stock goes down some, but once again, it's to mitigate as much as possible. Now, the whole point of this fund and the whole point of this portfolio is essentially to invest in 3 major index funds. So once again, these are basically 3 large index funds. The first one being US stock index fund, then it's an international index fund, and then it's a bond index fund. Now, there's a lot of ways in which you can set up this index fund and different funds that you can invest in. One of the ones in ways you wish you could do this is Vanguard. It's one that I particularly like, but in no way do I feel you have to do this one. In no way am I affiliated with Vanguard, or no way do I have any affiliate links trying to, promote and get more money from Vanguard. There's no affiliation there. I just find that Vanguard's a really great company. There's all kinds of great ones though. There's Charles Schwab, there's Fidelity. There's all kinds of apps on your phone, Webull, M1 Finance, all these great things. But, Vanguard is a really great one. And so there's a couple different ones that you could use. For the US stocks, you could use basically the Total Stock Market Index, also known as VTSAX. For the international stocks, you use the Vanguard Total International Stock, which is VTIAX. And then for the third one, you could use Vanguard Total Bond Market, which is VBTLX. How do you go about investing in it, and what proportion or allocation do you do this? Well, it's really going to depend on your particular scenario or your setup and how old you are. You see, typically when we're younger, we can do a lot more riskier investments. We can get a little more aggressive. And so if you are, let's say in like your 20s, your 30s, or even your 40s, I would say have a lot higher stock percentage than bond percentage. So you may want to do, let's say, 80% stocks and 20% bonds. But then as you get older, and let's say you're heading towards your 50s or your 60s or your 70s, you want to reverse that. And you may want to have closer to like 80% in bonds and only 20% in stocks. Remember, the more heavily weighted you are in the stocks, the more volatile it's going to be. And the more that you're weighted in bonds, the less volatile it's going to be. Now, there's no hard, fast rule or steadfast rule on exactly how much you should invest or the exact proportion. I would say just kind of pick something that is for you, depending on how aggressive that you want to be. There's no right or wrong answer. Any combination is fantastic. Just know that the heavier weighted you are in stocks, the more potential upside, but a little more risk. And the heavier you are in bonds, the less upside, but the less risk. So what about timing the market? Is right now a really great time to invest in the market? Should I wait? What's the deal? According to a study done at Charles Schwab, they found that 74% of the time over a 12-month period, stock markets always went up. So 74% of the time. Now, when it comes to should I invest now or later, they found that typically over a 20-year period, it's almost always better to invest now than to wait. Because once again, no one truly knows the timing of everything. And it's better to invest now than to try to wait for a low and then buy then. Because you never know when the low is going to happen. So overall, I feel that index funds really are much more advantageous to individual stock investing. Studies show time and time again that index funds simply do better than individual stock picking over 90% of the time, especially when you draw it out 15, 20 plus years. Of course, there's going to be years where individual stock makers or pickers are going to 5 times their money or double their money in a month or a day. And then they're going to be on there being like, oh, hey, look, I doubled my money in a week. And you're over here collecting your, 10% or 20% or whatever you're getting. But just know that over the course of a 10-year period, that people always typically do better, especially over 15, 20 plus years. And in fact, the index funds over the last 10 years have averaged a little over 13% return over the last 10 years, which is pretty phenomenal. But anyways, that's all I have for today. If you haven't done so already, make sure you smash that like button, hit the subscribe button for me if this video gave you some value. Also, be sure to share it with some people that you know that maybe could use this information. Check out some of my other videos. I post regularly on index fund investing, stock investing, financial advice, building wealth in your terms, entrepreneurship, making more money, financial freedom. Basically, anything money related is probably going to be on my channel. So make sure you check that out. Make sure you hit the subscribe button. And and let's get out there and let's build that dream.